So for most founders, getting listed is a significant landmark and probably regarded as a vindication of the founder's vision. However, there is a different set of public investor expectations post-listing, including, expectations of board transformation, transparency in reporting, succession planning, executive remuneration, something that, startups never had to deal with in a much more granular fashion. So with social media and a public discourse, which happens almost over every small matter, how do founders live up to the expectations of becoming business icons? To discuss this transformation and the management of a different set of stakeholder expectations, we have a panel representing a diverse set of stakeholders. They'll be in discussion with IiAS's board member Alok Vajpeyi. So we have with us Promeet Ghosh, who's Managing Director India at Temasek Holding Advisors India. So prior to Temasek, Promeet has spent over 20 years as an investment banker, including as MD at BSP Merrill Lynch, which was the investment banking arm of Bank of America in India. We also have with us Akash Prakash, who's the founder and CEO of Amansa Capital. Akash has worked at Temasek, GIC, Morgan Stanley Asset Management before setting up his own venture, Amansa. We have Manan Lahoty. Manan is a partner at IndusLaw's capital markets team. He has advised on several large Indian transactions in the domestic and international capital markets, including Coal India's IPO, Zomato IPO, the CPSE ETF, which came up, which was the first of its kind product in India, and the stake sale by Daiichi in Sun Pharma. And we finally have Pramad Jandhyala, who is the co-founder and promoter at Latent Analytics, which is an analytics partner to the world's most recognized brands. They recently IPO'd. Prior to co-founding this company, Pramad has spent over a decade in the financial services space with firms including IBM, Ford, and Moody's ICRA. Moderating the discussion, we have Alok Vajpeyi. Alok is the chairperson of Avendus's alternative investments platform. He's over 40 years of experience across UK, Asia, India in a variety of roles, including global capital markets, investment, wealth management, and later as a successful entrepreneur. He's also held several senior positions in global institutions, including EY in London, Swiss Bank Corporation in London and Asia, Barclays Bank in Asia and India, DSP Merrill Lynch, DSP BlackRock, and Daiwa in India. So any of you, if you would want to go through the detailed speaker profiles, again, they're available on the event portal. A word of thanks at this moment to our sponsors, IIFL and KPMG, who have helped get this event to you. We'll begin this event shortly after a 1-minute sponsor video.
Good afternoon. And I have three old friends and a lady who doesn't know me, so I'll be especially nice to her, Pramad. Very nice to have all of you here. The topic for today's panel really is a very wide-ranging one, which just says private to public. And we've only got 40 minutes. I mean, if I was to just ask Akash to speak, he could probably speak on this for 3 hours. And I've seen a note, Akash, that you wrote that Amit Tandon sent to me, which actually covers everything. So I don't think you need me or anybody else here. But what I suggest we do, and is basically therefore distill it down to a very specific point, which is basically insights and lessons for promoters, founders, entrepreneurs who are either moving from private to public or are just become public recently. A lot of them have become public. And what are the challenges and the lessons for them that between the four of you, you would actually talk about and ascribe? Now, before I move too far ahead, let me just introduce the panel, which overwhelms me. And I usually like to hog the mic, but I think with the knowledge, the intellect, and the experience of the four people on the panel, I will keep quiet as much as I can. So, Pramad, as I said before, you are the one I only know by reputation, because Amit Tandon also said that you're a superb entrepreneur. I've seen now what you've done by having researched what you've done, and you've created a great business. You've taken it public. So I think your inputs into this discussion, which are going to be experiential, would be very, very useful in terms of what you saw, what you learned, and what you would recommend other entrepreneurs who have been or who would like to be as successful as you. Akash, we last met, I think, at the Conrad Hotel. We had breakfast together because Naren Nagpal, your best buddy, bumped into Tina, my wife, and you. And we had a wide-ranging conversation then. But you are an outstanding role model, not only as an investor, but as an entrepreneur. You set up your business as an entrepreneur in 2008 and saw the bottom, but you sustained and continued with it. So not only would you bring your experience as a thought leader and as an investor, but I think it'd be very useful understanding your experiences of how you've actually stayed through the course and actually built a superb business. Promeet, we've known each other in the 2000s. We worked for the same man, Hemendra Kothari. I used to run asset management for him. And you were, one of the biggest investment bankers at that time. So you moved from the sell side to the buy side very successfully. And you are now running India, as far as I understand, for Temasek, which is one of the leading institutions, investment institutions in the world. So your insights from including private and public would be very, very helpful. And Manan, I know because I used to see him very early in the mornings in the gym, and he used to be doing all kinds of things which just brought the sweat out of me. He's very fit and he's very rigorous in the gym. And I believe that the same rigor that he showed in the gym is what he brings to his work, because he's an outstanding lawyer working, and one of the outstanding lawyers certainly in the capital market space. So I think, Manan, what you will bring to this panel is your experience as an insider, in fact, as an advisor, insider, somebody who can beat the promoters and entrepreneurs into doing the right thing at the time of IPO as well. What I'm going to do, I'll just take 2 more minutes. What I'm going to do is to break this session into 3 parts. One is, what are the key challenges and preparation that entrepreneurs need to do moving from private to public? The second point is, what are the challenges, decisions to be taken, etc., at IPO, things like valuation, allocation? That's a smaller piece of the discussion. And then, I say to a couple of companies which are going into IPO right now, life only starts after the IPO, because that's when the challenges really become, that's when you need to change and become, governance related. You need to do a lot of things that you've never done in your life before. So let's move to topic 1, which is challenges and preparations. So what I'd like is perhaps starting with you, Akash, really take 3 minutes each from you, then Promeet, Pramad, and then Manan, basically talking about, what are the 2 or 3 key areas that you would say are challenging, what are entrepreneurs need to do before getting into an IPO, so to speak. Things like, in my mind, are board transformation, quality of board, management team reset, cultural transparency, dealing with succession plans, incentivization, compensation setting not being as egregious, etc. You don't have full control of your company anymore. So simply because you have just written about the whole thing, Akash, it'll be great if you take 3-4 minutes and just come out with 2 or 3 really things succinctly, if you.
Yeah, sure. Well, thanks, Alok. Nice to see you again. No, I think from my point of view, I think you summarized it in a way yourself, right? Which is that when you're going from being private, numbers don't matter. No one can see your statements or your financials, to a situation where everything is visible to everyone. And now you have stakeholders of all types. You're typically going for a private company where you may have, 15, 20, whatever, depending on your cap table number of investors, to a situation where you will have hedge funds, long only funds, retail investors as your shareholder base. So I think one is obviously setting up the board is critical. Making sure you have a board which which is independent, brings gravitas, and helps you make the transition from private to public, because the challenges of a public company are very different in terms of quarterly disclosures, setting expectations, having a valuation number out there, and so I think that's one critical thing. Second is also, I think, my personal view is that one thing I find entrepreneurs don't spend enough time on is really trying to understand what type of investors they should try to get when they go public, right? Because a lot of these companies which are going public today in India are companies which historically are of a different type to what India is used to. Many of them are still loss-making. Many of them are still building businesses at various stages. And you need an investor base which understands that, right? The classic a lot of Indian investors may not fully understand how to value or how to look at a company which is still making losses, and you need people who buy into what you want what the company to develop into. So I think it's just really a mindset change of getting used to setting. Also, I would say you need to be clear what is the information and the metrics that you are going to disclose, right? You have a situation where you need to be clear that what are the guidelines or the metrics that you want to disclose to the public, which you want to be measured on. And you need to be clear what those metrics are, what the consistency on those metrics are you're going to deliver. And you have to be clear that, what is the long-term message you want to communicate to investors. So I'll leave it here very short, because I think it's the board targeting your investor base, being clear what disclosure requirements you're going to stick to. And the final thing I would say is that, in my humble opinion, I think founders tend to leave the IPO process, going public process, very much to their investors, which I think is a mistake, actually, because the reality is, in many cases, I found that the founders are not selling any stock at all, actually, in the IPO, but they let themselves come out at a very, very high valuation. And they have to recognize that very high valuation means very high expectations you're setting for yourself. So you're putting this huge burden on yourself when you really may not need to. So I would suggest that the founders be involved in the IPO process, in the valuation, in the allocation. It's not something they can subcontract or outsource to the investors who are selling or to the investment bankers. And we can get into that in more detail later, but I'll stop here.
No, so I think that is going to be part of point 2, but I think we'll just have a flowing discussion. Can I just ask you one question? When you say what type of investors and targeting the investor base, are you talking when you're raising money private, or when you're allocating?
No, when you're allocating, because I find that what I find again is that, the founders are very much driven by the investment banks. And I've written this actually, I was very unpopular with the investment banks for saying this. But the reality is the investment bankers will allocate to their best clients who pay them the most money.
Yeah.
That's not necessarily the best client for the company, right? Because you have all types of funds, good, bad, big, small, high turnover, low turnover. The funds should target investors whose mindset suits what the company wants to do, whose mindset syncs with the founder. That may not necessarily be the best client for the investment bank. So you can't outsource this to an investment bank. This is your company. The investors are your investors. They're going to sit on your head.
Yeah.
You have to develop a relationship and be clear who you want to deal with and who you don't want to. It can't be outsourced.
Promeet, would you like to carry this forward as an investor?
Sure. Alok.
And you can also bring your investment banking. If you take umbrage at Akash, then
I apologize.
So.
Yeah, I've got to take that up with Akash, but perhaps separately. It's actually, as you say, because I've been an investment banker for 20 years, I want to calibrate the discussion a little bit, because companies that I took public, 10, 15 years ago, when I used to be a banker, are a little different from the ones that we are taking, who are a bulk of the IPO candidates currently. Earlier, you would have a company which, largely promoter owned, who, went out and sold their shares into the public markets. Today, very often it's actually a process where you first get seed funding, then you get venture, then you get private equity, and finally you go public.
Yeah.
Right? Therefore, one big difference between being private and public is substance. In when you are private, very often you have large shareholders who engage very deeply into your operations. So you have to be constant. You're thoughtful about substance. But when you go public, you have to be thoughtful about substance and form, because obviously public markets are looking at both how are you doing what you're doing, as well as what you're doing. So that's point number one, and obviously that has many implications for companies. Second, one thing that people have to understand, insofar as public markets are concerned, and I do find that this is not always well understood, that public markets move on the basis of expectation, right? And not just on the basis of fundamentals. And I think that frequently is a bit of a surprise for people, because as Akash said just now, what public markets are doing is constantly on a short fuse, holding you to what you said, right? So it's not some kind of fundamental valuation that's always coming through, because obviously if your stock is trading 5, 6, 10, 15, 20% up or down in a month, that your fundamental value isn't changing within that period. So what you are continually being tracked on, which is different from being private, where you are being tracked by private investors, but they have the perspective that, look, if you said something now and you said something is going to happen by the 31st of January, it may not happen. It may happen on the 30th of March, or it may happen 6 months later, so long as the track is okay, etc. Public markets are far more focused on sensing whether you're whether you kept to your promises or not. And thirdly, I think, again, perhaps a learning for, entrepreneurs, far too often, the public market valuation of a company gets equated with what the company is worth, or even what the perception of the company's own self is. The fact of the matter is that public markets move on a large number of factors, and being unduly focused on that marker, which continually moves throughout the day, is actually a distraction, right? The one job that entrepreneurs have is to create value. And that value is not getting destroyed if your stock is down 5% today, right? And it's not getting created if it goes up 15% tomorrow. Just so we are completely clear, right?
Yeah.
You have your focus, and this is not to say that entrepreneurs don't understand this, but it's just something that needs to be reinforced. That 5 years down the line or 10 years down the line, is your stock 5 times, 10 times, or whatever it is. That's what you got to be focused on, rather than the interim stock changes. So I'll stop there. And
can I just paraphrase three things that I understood you to say? One is that private versus public form becomes even more. So how you present yourself, how you communicate, and how you behave becomes very important, other than the substance which you have to have. Then, so it follows through from that, that setting expectations becomes very important, therefore the communication of which. And the third thing you talked about is don't focus on the share price on a day-to-day basis. Build value and think about it in the long run. Yeah?
Absolutely. Build value and the investors will come.
Yeah, well,
yeah.
So Pramad, your experiences, the luminaries here have talked about a number of things. How well prepared were you? What did you know, and what came as a surprise and a shock? And what would you like to talk about?
Yeah, thanks, Alok. If I may, maybe I'll just start with a brief introduction about my company. I'm not sure if all your audience would know. So my company's name, Latent Analytics. We started in 2006. We are an analytics firm. We help mostly Fortune 500 companies drive their business forward using data and analytics. We recently went public in end of 2021, so it's very early days for us. So maybe that's my fantastic disclaimer for today, that anything I say cannot be used against me. But no, I think both Akash and Promeet have set the stage well in terms of what is it that companies need to look for. And from our experience, maybe what I can share is we looked at the notion of being a public company in a couple of different ways, right? Firstly, even when we were young, we'd always ask ourselves, can we behave like a public company, even though we were private, right? So, that essentially just meant building a certain level of robustness in our teams, in the way we go to market, in our processes, to some extent reporting as we understood it, right? The second, I think, was a very nice distinction which an advisor along the way, when we were getting ready for the IPO, brought out very nicely, was going public and being public are two very different things. And I think that clarity was really useful for us to kind of, even as we started the process of going IPO, we kind of said, hey, what does being public look like? And that's a very distinct responsibility from going public, because that itself is a very intense process, the process of going public, because there is a lot of steps along the way. One piece of it is, of course, the whole piece around the board. We talked about the kind of investors that you want, filing your prospectus, all the compliances that you need to have in place. And lots of times you don't know what you don't know. And you are then relying on advisors to guide you along the way. And the reality lots of times is also the advisors, while they have all the experience in actually understanding of what it takes to go public, they may not understand our business the way we do and what is it that we want to convey. So I think that fine balance of working with advisors to arrive at all the disclosures that you need to put in. Are they being represented in the right way? The funds that you want to raise. In our case, the majority of the funds that we raised out of our IPO, ours was a 600 crore IPO, and around 80% of that was primary funds that went into the company. Just working through that whole process and putting together the substantiation for it, I think is itself a learning. It's like, the first time you build a house, there's a lot of skills that you learn along the way, which you may never put to use again for perhaps you'll buy another home and maybe you'll put those skills to use. But I think in the case of going public, that's probably the one and only big milestone. So I think those are two distinct phases in terms of how we approached it. On the first phase of, trying to behave like a public company, even when we were private, I think for us, the transition was something that we had in our mind fairly early on. So even though we started out in 2006, we actually brought on board a professional management team 8 years after we started off. So we had a professional CEO in place for 7 years prior to going public. You talked about incentivization, ESOPs, all of those I think are very specific to the sector that you're in. So in some cases like technology, for instance, which is where we belong, it tends to be fairly broad-based. So those are all, I think, choices that we made fairly early on. So setting ourselves up right and a certain level of readiness, I think really kind of helped us make that transition. So business in some sense was not as affected because it did become business as usual to some extent.
So Pramad, if I may put a question to you while we move forward, is you behave like a public company even when you were private, which is what I would advise anybody to do. Had you not done that, and most people don't understand that, how difficult would have been the process? So if the process was difficulty-wise 7 out of 10 or 8 out of 10, or say 6 out of 10 for you, much more difficult would it have been in terms of timing, in terms of dealing with advisors and everything else?
Yeah, I think it's possible, very much possible. Possibly the amount of time that you would factor to be IPO ready might be a little longer. In our case, from the time we started the whole IPO process to the time we went IPO, it took us about 6 months. And I think I credit the 6-month period to the fact that we tried to get ourselves ready from pretty much our early days.
No, 6 months is terrific. It's fantastic. And how good did you find your lawyers as advisors before I come on to Manan? You don't have to answer no, but please do. Yeah, go on.
Yeah, no, I think, as I said, advisors show you the way. And I think it is important to get a good set of advisors, whether it's lawyers, whether it's bankers, and all the different players. But I think it is possibly important for the company to be as involved at every stage of the decision making. It takes effort because you are lots of times playing the role of a referee because you understand best what is it that the company needs. So it was good for us that it was only an intense 6 months. God help us if it was an intense 6 years.
Manan, I've taken many digs at you. Please kill me when you see me next. But, your experiences across far, far more companies than either the investors, because you actually get into the weeds of each one of those. How do you see that experience? How do you see the preparedness of, there'll be very few like Pramad's, I would assume.
Yes, thanks, Alok. And yes, I'll see you in the gym soon. But beyond that, I think, just kind of adding to what Promeet had mentioned, the kind of companies we were IPOing, say, 10, 15 years ago, which were basically companies from large business groups, very large stake held by promoters, some held by private equity investors. That's changing a lot. If you see last 10 to 12 months, the number of tech companies which have IPO'd, almost all of them have no promoters. They have founders, but no promoters. And the difference being they're not controlling shareholders anymore. They were at the start of the business, but over the years, they've diluted, in some sense, their governance standards have already been established to some extent by the existing investors. The board is not majority controlled by the founders anymore. So we, very happy to hear from Pramad, her views and how she went about it. But yes, we are beginning to see a lot more a lot more readiness much before the IPO lawyers come in the room. But what we normally like to discuss on kind of day one, and maybe it's relevant for this conversation as well, is more on brass tacks. The first is your governance. Where do you want to draw the line? One is the bare minimum law. Everybody knows that. We had the session before this, which actually went to a lot of nuances. And then, on the other end of the spectrum is, kind of trailblazing, right? New standards, markets not seen. We've actually seen that happen in India in the last 12 months. Most companies will fall somewhere in between, which is fine. You just need to know what you want to do. One conversation that we are beginning to see a lot in the boardrooms these days is, hey, listen, we want to list in India, but we want to be as good as a US listed company would be, especially in tech space. Also with the ambition that in the next 2, 3, 4 years, the company will also be listed in the US. So there will be dual listing, India listing plus a US listing. Should we start preparing for US listing then? Or should we go to the markets today saying we are as good as a US listed company would be? So I think knowing what your standards at the start will be and how you will ramp up is actually the most important aspect. How long you will take, what you need to do follows from there. Some of the brass tacks, which we normally discuss with people is, beef up your senior team, right? I mean, advising a client, which has young, solid founders with lot many more years to come, with a lot more wisdom already in place, but they chose to have a professional CEO come in before the IPO. So that's not very common still in India, right? We don't think of bringing in professional CEOs when you already have a bunch of founders who are still very active, very young, still full of ideas, still haven't implemented what they set out to. But yeah, the idea is look at your CXO team. Do you need a CFO ahead of the IPO? Try to bring somebody in advance, that the person is comfortable, person is familiar. When the person speaks with a sense of authority, both investors, regulators, are able to believe what the person is saying because the person has some kind of conviction, having known the company, been in the company for a while. So the second big thing that we discuss apart from governance is, do you have a senior enough team in place for an IPO? 2, 3, again, kind of, more operational aspects, but they become very, very important. Once quarterly close, unlisted companies are obviously, sorry, did my internet let me down? Sorry, can you hear me, Alok?
No, you froze a little bit, but.
Is it okay now?
Yeah.
All right. So the third thing I was mentioning is, private companies are obviously required to only prepare annual accounts. When you will IPO, you will have to start thinking about quarterly closure for a few quarters before you start the IPO work. It's needed for the IPO diligence, but it's also, once you're a listed company, you will need it. We've seen situations where, the board was ready, the investors were ready, the founder was ready, the bankers were ready, the IPO investors were ready, but we could never get the document out in time because the company was not used to closing the accounts quarterly previously. And if they wanted a June quarter to go in the offer document or a September half year, they were just not in a position to do it for good 4 or 5 months after the end of that period. So quarterly closure is very important. Linked to that, it might seem again a very operational aspect, but it's a fairly important from marketing and going forward perspective, is KPIs. What KPIs are you following when you are developing your strategies? You have to think about what your IPO investors and public investors will be asking you, because what they ask you eventually is what IPO lawyers and IPO bankers will ask you. I mean, I have seen companies being fully prepared, very detailed strategies, but not thinking of the targets and the KPIs that IPO investors or IPO bankers will need. So start thinking about what is needed. Maybe you need to fine-tune your strategies to achieve some of the goals which public investors will be looking at evaluating you on. So just about 4 or 5 of these things we normally start with on day one of our conversation.
Okay, so can I throw it open? Any rejoinders anywhere before I move on? Anybody? Akash?
No, I would agree. I think the point they all made, which is that, when you go public, the consistency of information, the disclosure. I mean, the reality is you are now an open book to a certain extent. So the disclosures required, the consistency of disclosures, the type of information required is something which a private company may find not either used to or difficult to handle. And we've seen certain situations where rookies in the private space compared to Promeet and other people. But I mean, some of the stuff, I mean, frankly, quite amazed at some of the stuff that we've seen in the private space. It would never pass muster in public markets. I mean, related party transactions, inter-party stuff. I mean, stuff which is really, I mean, I'm actually astonished at some of the stuff which is taken as part and parcel of part of the game in private companies would never pass muster in public. So I think, frankly, it's odd to say it, but I think there is a slightly different standard of governance, a good public listed company, what's expected. And I think some of the private companies, partly because maybe they've got rock star founders or rock star LPs or investors, some of the stuff these companies are getting away with would never they would get away in the public markets. There's also a mindset shift you have to make. The public markets are unforgiving. They don't care who you are, what your background, where you studied, or what you did. The standards are consistent, and you have to meet those.
So, I mean, I'll just stay with you for a second. One of the things that you wrote about, which was the quality of investors that you take in the private space matter, and therefore your cap table is very important for public investors to actually put faith on. How real is that, and how much does it matter? Maybe you should answer it because you've already written about it. Do you want to go on that?
Sorry, who did you ask, Alok?
Well, sorry, I mean, so what I said was, Akash has said in the past that the quality of your cap table or the investors who you have as a private company and also the board quality at that time actually make a big difference in public investors residing faith in the IPO, right? So Akash believes that. How much do you really think about that when you're investing in public?
Yeah, I love to say, Alok, that it matters enormously. And of course, the one quality investor you should have is Temasek and so on and so forth. But I'd be very self-serving there. What I want to take this a slightly different lens. It's a very important lens, but also very topical. See, what's happened today is that capital has become a commodity in effect, right? Because obviously everybody and his aunt believes that lots of our early stage companies will return massive returns to shareholders. So lots of investors, not only institutional investors, but family offices, high net worths, and so on and so forth, all vying to be a part of the pie when the company is still private. And so therefore, capital is not always an issue. But again, I go back to that initial point that I made earlier. It's the job of the founder, of the promoter to create long-term value and not necessarily only maximize the valuation that they get at the funding round or even at the IPO. Right? One of the reasons that you hear people say you should have quality investors is because capital markets recognize a good quality investor set, and therefore you'll get a higher valuation. But even beyond that, the fact of the matter is that all the rigor that goes into building these companies, generally, if you've got quality investors, they will help infuse your company with that rigor, with that discipline, with that experience that you have had, that they may have had in other such companies. Remember, again, one big difference between 15 years ago and today is that our companies which are going public today have not had the same time to mature as companies of the yore. These are companies which were formed 4 years ago, 5 years ago, or 3 years ago, which have grown very, very sharply and now are going public. And because the time is so short, the time for them to season is obviously shorter. And having a good set of shareholders who've seen this before, to guide you through this journey, not of listing only, but of growing your company, creating value of the company, presumably they will be able to help you better, and hopefully they'll put you in a better position to, again, in the longer run, make a company which is much more much better suited.
So can I just, because I think we'll run out of time in 3 minutes, but I had a question of Pramad. When it came to setting, with pricing the IPO, how did you approach that in terms of, taking the maximum out, and how did your shareholders who existed before, how did you balance the future versus maximizing the valuation?
Yeah. So for us, prior to the IPO, we were a very closely held company. The only people who owned the company were the promoters and employees. Right. So in that sense, taking existing investors along was not really such a big challenge for us. But from a choosing of investor perspective, of course, we did have a long wish list, right? And I think it's no similar from when you look at company building. It is a long haul. And any partners that you're looking for, you're actually looking for partners who are in it for the long haul too, right? Be it, customers who are sticky customers, be it employees, and with investors as well, right? So I think for us, we were really looking for investors, long-term commitment, who would be willing to trade off short-term gains and actually bet on long-term growth. And most importantly, just willing to spread amongst their circles their faith and belief in the company, right? Now, this is a wish list that we went with, right? But clearly, as a young company hitting markets for the first time, I think we were able to attract an excellent set of investors. I think the journey begins now for us to understand all the things that Promeet was talking about, right? Which is investors also do want to stay with companies who will grow over a 10-year horizon.
Yeah, but I think my question also, but how much time do we have, Anup?
We can continue for a few minutes, Alok. Okay. 3 to 4 minutes. Yeah.
So I just, I still, again, I think I'll ask Akash, you see as an investor in these, that there is a great frenzy around, I want the maximum possible, basically. And the bankers and there is this tension between everybody, including the shareholders selling, etc. What do you, your experience of greed in that, and how does it affect the future?
No, I think as I said before, I think the founders normally are not selling in the IPO, normally, because they, as Promeet points out, most of them have 10, 15% stake only. So I would think that they need to look at the long-term interest of the company, because the higher the price you set on the IPO, or the higher the valuation, the greater are the expectations which are embedded in that, and the greater the pressure you're putting on yourself. So my simple point is that, in most cases, your shareholders have made decent money. They're only selling a small portion of their, some percentage of their stake in the market. Let investors make reasonable returns, not some huge return, but make a reasonable return on the share initially, leave something on the table and build a long-term partnership, as what Pramad said, right? That you're trying to build a long-term relationship with investors. It has to be a balance. But my simple takeaway was, I find that the founders very often, delegate this process to the selling shareholder, because this is finance, is something I don't understand. Don't bother me. I'm busy building the business. This is going IPO valuation. This I don't understand. My simple point is that's a mistake, because if you don't get involved in setting the valuation, guess what? You have to live with that valuation, and the shareholder are going to come after you. They're not going to go after the shareholder which sold the stock. That they're out and out over their home, right? You are living in the company. You have to live with that expectation. So you should get involved in that process and make it a fair. Like everything in life, it's a trade-off. Right? Give a reasonable return to the investors who are coming in now. And that's what I'm trying to say.
Manan, you haven't had enough time to say a minute. Any conclusive thoughts?
No, thanks. I think the key, that I want to lay focus on is starting early, right? Pramad said that they started well in time. I mean, we've seen people come to us almost 3 years before they start IPO work. The reason being is the look back for an IPO is 3 years. So whatever you will do in the last 3 years before your IPO will affect your IPO in some way or the other. You don't necessarily need to be on a day-to-day basis engagement with bankers and lawyers in your IPO ramp or in your run-up to the IPO, but it does make sense as soon as you are clear that your IPO is around the corner, which is anything between 6 months to about 2 years. Start engaging with at least the advisors, get a sense, because this entire session is also on behavior, but equally on capacity building, right? Capacity building takes time. Behavior changing takes time, and it's not a switch. It's not one day you were private, the next day you become public. It's a whole journey, and it's a slow process, unfortunately. And the expectation in today's day and age is much more. Like somebody said, markets are very unforgiving, right? Even on governance and all these aspects, you need to be in a way public much before you IPO. So yeah, that's my sort of parting wisdom, if I may.
So, in paucity of time, what I will conclude with is build your private company, run your private company like a public company, as Pramad has done, and like a well-governed, public company. Build a strong team ahead of time, which is the CXs. There is huge tension and work to be done into an IPO. Value your IPO well so that, don't overpromise and therefore keep chasing your tail. And the real life, as everyone said, really starts after the IPO, because then your behavior and culture has to change into basically managing your business and giving the right expectations from it, as you said earlier, and communicating well at the end of it. So it's not simple, and these are just a few distillations of a much wider framework for this discussion. But I would just like to thank all of you for sparing the time, Amit for inviting us, IiAS for inviting us and giving us the time, and I hope this was useful. Thank you.
Thank you.
Pleasure.